Welcome to The Explainer. Today we're tackling options pricing, a topic that, let's be honest, can seem super complex. But stick with me, and by the end of this, you're going to have a really solid handle on how these things get their price tag. We're going to break down all the ingredients, from the hard numbers to the fuzzy stuff like market sentiment.
So here's our game plan. First up, we'll cover the absolute basics. What even is an option? Then we'll get into the anatomy of its price, the two main parts. After that, we'll dig into volatility, which is a huge driver of that price. And finally, we'll decode the Greeks, which are basically the cheat codes traders use to measure everything.
All right, first things first, before we can talk about the price of something, we kind of need to know what it is we're buying, right? So what exactly is an options contract? Okay, at its very core, an option is just a contract. Its value is tied to something else, usually a stock. Now, if you're the buyer, you pay a small fee. That's called the premium. In exchange, you get the right to do something down the road. The seller gets your premium, but they take on the obligation to follow through if you decide to act. And these contracts really just come in two main flavors. A call option gives you the right to buy. You'd grab a call if you're betting the stock's price is going to shoot up. A put option is the total opposite. It gives you the right to sell. And that's your move if you think the stock's price is about to take a nosedive.
And this is a really powerful way to think about it. That premium you pay, it's kind of like an insurance payment. Just like you insure your car against a crash, an investor can buy an option to protect their portfolio from a big, unexpected drop in the market. It's financial insurance. Okay, so we've got a handle on what an option is. Now, let's peel back the layers on its price tag. Turns out, every options premium is basically made of two distinct parts. And if you get these two parts, you've pretty much cracked the code.
So, ingredient number one, intrinsic value. And honestly, this is the easy part. It's the real, no fluff, right here, right now value. If you could cash in your option this very second and make a profit, that profit, well, that's its intrinsic value. The math here is super simple. Check this out. Let's say a stock is trading at $55 a share. You own a call option that gives you the right to buy it at a strike price of $50. Well, that option has $5 of intrinsic value for every share. It's a real tangible advantage you have. This is just a perfect analogy. The intrinsic value is the concrete foundation. It's the solid, measurable worth that everything else is built on top of. Now, an option can have zero intrinsic value for sure, but it can never be negative. It's either there or it isn't.
All right, on to ingredient number two, time value. Now, this is where it gets a little more abstract, a little more interesting. This part of the price isn't about what the option's worth today. It's all about what it could be worth tomorrow, or next week, or next month. You're literally paying for potential.
So think of it this way. Any money you pay on top of that solid intrinsic value, that's the time value. It's the extra cash the seller gets for giving you the chance over a stretch of time for that stock to make a big move in your favor. And this leads us to an absolutely critical concept called time decay. Just like that melting ice cube, an option's time value is constantly shrinking. Every single day that passes, a little bit of it disappears. The closer you get to the expiration date, the less time there is for a miracle to happen. So its value just melts away. And get this, it melts faster and faster in those last few weeks. So what makes all that time so valuable in the first place? Well, one of the biggest drivers, this unseen force, is volatility. It's basically a measure of how much a stock's price is jumping all over the place. Now, traders look at this in two ways. There's historical volatility, which is like looking in your car's rearview mirror. It just tells you how bumpy the road has been. But what really drives the price is implied volatility. This is the market's best guess about how bumpy the road ahead is going to be. It's like the collective wisdom or anxiety of all traders. And this is so important. When implied volatility is high, the market is expecting some big price swings. For an option buyer, bigger swings mean a better chance of hitting a home run. So that increased potential for a big payday makes the option more valuable and therefore more expensive. You're basically buying a lottery ticket on choppier seas. Okay, so you've got the stock price bouncing around, you've got time literally melting away every single day, and you've got these market forecasts on volatility changing. How on earth does anybody keep track of all this stuff? Well, they use a special toolkit known as the Greeks. Now, don't let the names freak you out. Just think of the Greeks as the gauges on your car's dashboard. Delta is like your speedometer. It tells you how much your options price will change when the stock moves $1. Theta, that's your fuel gauge. It shows you exactly how much value that melting ice cube is losing every single day. And Vega tells you how sensitive your option is to changes in that all-important road bumpiness, implied volatility. Okay, theory time is over. We've gone over all the individual pieces of the puzzle. Let's put them all together now and see how this actually plays out with a real example. Take a look at this. We've got two different companies, both with stock priced at $50. But Highvol Corp is expected to be way more volatile. Now notice two things. First, the options for Highvol Corp are literally double the price. That extra cost, that's the volatility premium you're paying. Second, for both companies, the option with 6 months left is way more expensive than the one with only 1 month. That is time value, right there on the screen. And this is exactly the job of those super complex mathematical models you might have heard about, like the famous Black-Scholes formula. You can just think of it as a fancy calculator. It takes all the stuff we just talked about, the stock price, the time left, the volatility, and it runs it all through a formula to spit out a theoretical fair price for the option. So let's wrap this all up. What's the bottom line? An option's price is just its real value right now plus its potential future value. That potential is fueled by time and volatility, and it's constantly decaying. And the Greeks? They're just the dashboard that helps traders see what's happening and manage their risk. If you understand these basic building blocks, you really do have the map you need to navigate the options market.
And I'll leave you with this final thought. Pricing isn't just about math and formulas. It's about understanding that things like time and volatility aren't just costs to be paid. They're strategic forces you can plan around. It's really all about reading the psychology of the market, that constant dance between what we know for sure and what we think might happen next.